Hello, I'm your host, Steve Sexton, and welcome to the Silver Hair Tsunami Show. With over 100 million people over the age of 50 in the United States, this demographic will have a profound effect on economics for decades to come. The Silver Hair Tsunami Show is all about educating people, getting them the information they need to know in order to managing the changing tides of retirement. It's all about making decisions that impact the quality of your life. On today's show, we have Alan Nevin. Alan's going to be talking to us about economics. See, he's the director of market and economic research for the Xpera Group, which is a real estate company. If you're doing real estate in San Diego or many other places, most people don't do it without Alan's advice. Now, he's going to talk to us about rate increases. He's going to talk about economics here in San Diego nationally, and he's going to talk to us about his new book called The Great Divide. It's about the transition of economics for the next 25 years in the United States. Then we have Jonathan Jerotz. He's the Vice President of Retail Sales for Synergy One Lending. He's going to educate us on the risk that we have in our mortgages and how to stop our money from falling through the cracks and have a problem in the future. So stick with us. We've got a great show for you. You know what? In a recent article by Financial Planning, the Institute for Insured Retirement Institute came out with some information that was startling. 45% of boomers haven't saved anything for retirement. In fact, only 24% feel that they have a secure retirement. Now, if you're not on track for your retirement, I've got 4 steps that you can take in order to get yourself on track. Now, the first one is you have to play catch up, which means you're going to have to get started. And one of the ways to find money is to look at reducing your expenses. It could be just as simple as taking lunch 3 days a week, which will save you $9,000 over 7 years, and that makes a big difference. But on top of that, look at the needless expenses that you have, such as Starbucks or eating out, drinking, going out to dinner multiple times. You can find money. A lot of times I've had clients who have switched cars because one is better on gas than the other, and it saves them 3 or 4 tanks a month, which is $250 to $300 a month in savings, which means more goes into the retirement. Secondly, we want to look at reducing our debt. Credit cards weigh you down. It could be a burden on your debt, so you want to look at paying them off first, then the car loans, and hopefully the mortgage. After that, you want to look at reducing your fees within your 401k or your IRAs. You know what? Most people pay over $138,000 in 401k fees over their lifetime. If you could reduce those fees, you'll have the opportunity to get a higher profit or a bigger return, which means more money for you in retirement. And last but not least, if you're serious about retiring, you want to max out your savings. Now, if you're over 50, you have the ability to put $24,000 in your 401k or $6,500 in your IRA. Now, for more information, you want to go to the Silver Hair Tsunami website. We'll be right back with Alan Nevin. Welcome back. My name is Steve Sexton, your host. You know, our next segment, we have Alan Nevin. Alan is the Director of Economics and Market Research for the Xpera Group. He's a wonderful man when it comes to real estate. Many people want it, or almost everybody is doing a real estate project here in San Diego and many other places, want to get his blessing to make sure it's going to work out. Alan, welcome to the show.
Thank you, Steve.
Glad you're here. Glad you're here. You know what? I wanted to talk to you about a few things, or actually have you educate us about a few things. How is real estate working nationally, and then how is it working here in San Diego, and what are the projections for, moving forward?
Well, basically, overall, things are pretty positive around the United States. There are a few spots that are overbuilt, and a few that are underbuilt. But pretty much we're doing very well. Okay. Now, in San Diego, which is the prime focus for us here today, tell me about how real estate's going. Are we seeing price increases? What are we seeing? Well, when I mentioned underbuilt, we're one of those places.
Oh.
Because if you just play it by the numbers, we actually are about 50,000 housing units short of what we should be.
Oh, so what does that mean?
Well, it means there are a lot of folks who are buying in Riverside who really don't want to. There are a lot who are buying in the eastern part of Tijuana.
Oh,
And of course, the occupancy rate in apartments has gone
through the roof.
up to almost 100%. So that's picking up some of the slack. And then there are a lot of people who are doubling up.
What do you mean by doubling up?
Well, there are 2, 3, or 4 to the apartment, singles included, young professionals. And it's a pretty difficult situation out there right now.
So what you're saying is when it comes to renting, landlords are loving it because rents are going up.
They are. However, I have found that the landlords are not being greedy.
Well, that's a good thing.
Yeah, the rents seem to be going up at 3 to 4% a year.
Okay, just
And that's,
almost an inflationary rate.
yeah, it's higher than inflation, but nonetheless, it's acceptable.
Well, no, I understand that. Now, when it comes to housing prices, what are we expected to see here in San Diego?
Depends where you live.
Okay.
And, the answer is overall, we're probably at the 5 to 7% a year increase, but there's some places that are going higher than that and others lower.
So in other words, like if you're closer to the beach, you're going to see higher because there's just no more homes there.
Well, also because of the out-of-town market and the Mexican and the Canadian and the Far Eastern market that isn't limited by qualifying for loans.
Okay, so they come in and buy cash, and that works out really well.
I mean, we're seeing condominiums near the coast selling for well in excess of $1,000 a square foot. A couple of the newer projects are up in the 1,500 to 1,800 square foot range.
Yeah, one of my clients, her condominium in Del Mar just went up $200,000 over the last 3 years just because there's a number of people coming in wanting to pay cash for them because they want a condo next to the beach.
Absolutely. And money's no object.
Now, you know what? We keep seeing Janet Yellen, not Alan Yellen, but Janet Yellen, she keeps talking about we're thinking about this rate increase. And then you have some people saying that we should do it, some people saying we shouldn't. You know what? I've talked to you many times before in the last couple of years.
Yep.
What do you think? What do you make of all this? Is it bluster? Is it trying to keep people, you know what? Where are they going with the rate increases? Or are they having rate increases?
I think it's absurd to raise rates. I don't see where our economy is so robust that we can stand an increase in rates.
So inflation is just non-existent?
Well, it's absolutely, it may be minus at this point, but that doesn't relate to real estate. I always try to point that out, that our inflation is mostly on consumer goods, and well, you know, with the price of oil down substantially, that affects the pricing on everything that's made of oil, and that's going down in that price.
Yeah, and last Thursday they just had that big meeting, and that big meeting says, hey, you know what? We're going to look at driving drillers out of this marketplace, according to what the Sheikh said in Saudi Arabia, so we can see oil prices going down for a little bit further.
Well, even if they stay in the 30 to 40 range, that's pretty much of a bargain, and that is an indication that we don't have any inflation. And we really don't.
Now, what do you make of when you look at Euro, you know, they're in negative interest rates. You got Japan, Sweden, many other countries in negative interest rates.
Well, I mean, look at Canada, which is doing beautifully, and yet their value of their dollar has gone from equal to ours to 20% less than ours.
Now, why is that?
It's just part of the economics of the world.
Okay.
I mean, going to Canada for vacation now is a marvelous bargain.
Well, that's the way it was when I was a little kid. That was wonderful. We loved it.
That's right.
We could buy a whole lot more.
Exactly.
In fact, we had Wayne Dunlap, a travel expert, said the world's on sale because an exchange rate's different. And in some countries, they're 20, 30, 40% less than ours.
Oh, yeah. Argentina is an unbelievable bargain. But even Europe is down almost, not quite, but down to that 1-to-1 level, whereas 5 years ago it was $1.50 to 1. And so we're...
Yeah, in the 90s, there's a $1.92 to 1, yeah.
Yeah, but the basic point is that the U.S. is incredibly strong as a nation economically, and other places aren't doing as well.
Now, if you were to predict, hey, when would I likely see a rate increase? Because I don't foresee, you know, I personally don't feel they're going to increase rates because it create problems worldwide. because obviously the U.S. dollar would be, worth much more, create problems with our trade, all that kind of stuff. When would we like to see some sort of rate increases here in the United States?
Well, the reality is that our construction market, our single-family housing market, isn't very strong now. And raising rates would not be a terribly bright thing for the government to do, because it would probably discourage people from buying. And we really need to keep those rates low to keep the home building business moving forward in this country.
Would it make sense to loosen up the credit? That Dodd-Frank came in and constricted the ability for people to qualify for loans and all that. Do you see that, loosening up a little bit?
The answer is that it's nowhere near as bad as people think. And if you have a decent credit score, there's tons of money. The banks are desperate to get money out. So there's really not that terrible a situation. And you can even get subprime loans today.
Oh.
For less than what First Trust needs were going back in 06 and 07.
Oh, so what are subprime loans going for right now?
Oh, 7-8%.
Okay, so if somebody can afford 7-8%, that works out quite well.
Yeah, but if you have a FICO score over 600, you're pretty good shape to get yourself a traditional loan.
Now, from a planning standpoint, so if you were looking at somebody that had a decent amount of debt, this would be the time to get it paid off, because once interest rates start moving forward, do you think they're going to start moving forward like Alan Greenspan did way back when he started raising almost a quarter a month?
I don't see that happening. I really don't. As long as countries like China and Japan have interest rates that are effectively zero, I don't see the math. I don't understand why anyone here would want to raise rates.
So it looks like we've got a long time before interest rates rise.
I think so.
That's wonderful, Alan. Hey, you know what? My understanding is you have a new book coming out.
I do.
Tell us all about it.
Rather quickly. It's called The Great Divide, and it really talks about the next 25 years in the world and the United States and what's happening not just economically, but demographics. And demographics really guide what happens in the world. And there are basically a handful of nations that will do very well in the next quarter century, and a handful of states here in the United States. Basically, there are 14 states that make up about 75% of all the economic growth in this country.
Hopefully California's in one of those.
We're the leader.
Okay.
We're tied with Texas and Florida.
So why are they leaders?
Well, it's interesting. California is a leader because we have such incredible growth in our high-tech industries that we lead the world in biotech, social media, certainly, and the electronics, and really aerospace as well. We're not building as many planes, but we're creating the components. So we're really doing very, very well in the state. I mean, we're gaining over 300,000 jobs a year in this state. And that's,
oh, wow.
That's pretty, we've done.
Even with all the taxes and all the regulations, we're still gaining that many jobs.
Since the recession, we've added 1.8 million jobs in this state.
Is that because in the Midwest and many of these locations that industry is leaving, like you see Detroit, Michigan, you see industry leaving and people are trying to find worthwhile jobs, so they're coming out here to California? Is that really what it comes down to?
Basically what happens is when a smart kid gets out of high school in Detroit, they come south. It might be Atlanta or Dallas or San Diego, but they leave. And what you see in all of these Midwest, northeastern states is that the median age keeps rising because the kids just keep leaving.
Okay.
So it's really a situation that hasn't changed, by the way. I've been tracking this since the 70s, and the trend has not changed one iota.
So what you're saying is when industry starts compressing, the smart people start leaving and going to places where there's opportunity.
Absolutely.
And that's going to continue to happen for the next 25 years, and there's going to be 14 or 15 places around the United States where most of those jobs are going to be, and then we're going to see the little dust towns, so to speak, in the inner cities that aren't focused on their economic survival.
Yeah, we have more or less a half moon that starts at the state of Washington, works its way around, down through California, over to Texas, Florida, and up into the Washington, D.C. area. And that's where 75% of not only all the new jobs are taking place, but all of the population gains as well.
So if I was looking to invest for the future, I'd be looking at certain states, and if I was going to look at making money in those states, it would make sense of those top 14, wouldn't it?
You really have to do that. And I feel very badly for people who own properties in the states that are going nowhere.
Yeah, I understand. Alan, thank you for being part of the show today. The information you provide will make a difference in people's lives, and thank you for being here.
It's my pleasure, Steve.
Now, stick with us. We've got one more piece for today. We have Jonathan Jerotz. He's the Vice President at Synergy One Lending, and he's going to talk about the risks that we see, or he sees in mortgages that could have your money falling through the cracks. So stick with us. We'll be right back.
Hi, my name is Min Lee. I live up in Carmel Valley, northern San Diego with my 2 kids and wife, and we had our solar installed by Baker Electric Solar. We went with solar because we wanted to be environmentally sound, but ultimately it came down to being financially sensible, and the prepaid lease was really the best option. There was only one payment up front, lock in all of our utility rates. We'll get our return back in about 6 or 7 years, kind of like a bond or a CD. We had no headaches, no stress to worry about. If you're thinking about going solar, now's a great time. Our electric bill is 0, and you can't beat that.
You know, we've been hearing a lot from Janet Yellen here. And basically what she's been talking to us about is, when are we going to have some rate increases? And we've heard that, you know what, it might happen 2 or 3 times before the end of the year, depending on what happens with oil, inflation, and so on. But you know what, a lot of people don't pay attention to their mortgage, and this could be a death knell. This could be a position, and interest rates go up, where you start having some of your money fall through the cracks when you thought it was safe. Now, the big thing here is we have J.J. Jerotz from Synergy One Lending. He's a vice president in charge of retail sales and a partner there. He's also the mortgage voice for the Padres. J.J., welcome to the show.
Thank you. Always good to be here.
Well, thanks for being here. Hey, you know what? One of the big things I want to talk about is, you know, how could these mortgages that people don't realize that are toxic could become very toxic when rates start going up?
Well, you know, a lot of people don't know this, Steve, but in 2016, the largest number of adjustable rate mortgages are set to adjust or reset in the last 6 years. So you're talking about millions of mortgages across the country that are going to adjust. So people have adjustable rate mortgages. Maybe it's a negative amortization type of loan that's still kind of hanging out there. They haven't refinanced it yet. And if long-term rates go up, mortgage rates start increasing, these people then go to refinance. They're just losing money by not securing or fixing in that long-term debt.
Well, you know what, I understand that, because basically they've become comfortable in paying that negative AM payment, which might be a couple $1,000s a month right now, but they're going to move into a 30-year fix where they've got to add principal on top of that.
Right.
And that payment might be $4,000 a month. They could be in a position where they might not be able to qualify because interest rates are now 5 or 6%. So it's important to take a look at it now. That's pretty much what you're saying, right? Without
a doubt. And if we go back to 2006, 10-year interest-only loans were a very popular choice in 2006. Yeah. So just to your point, you get comfortable making that interest-only payment. You didn't have to do much to qualify for it back in 2006 to get the loan, and now that's going to adjust. Well, if it's a 30-year loan, not only is it going to adjust to a principal and interest payment, but it's also going to adjust to a 20-year amortization. So you could go from a $2,000 payment to a $4,000 payment overnight.
And here's the big thing. A lot of people in that environment, and I've seen this before, where they've got used to spending that extra money, and as opposed to saving it for the mortgage, and that's going to create some bigger problems because they might have other obligations for that extra $2,000, and they could be in a big trouble.
Yeah, and you know, it's one of those things you just kind of have to look at it. I mean, I think everybody should talk to their mortgage professional who they work with, and annually do a mortgage checkup. I mean, I do it for all my past clients. I mean, every year you got to look at it, see where they're at, see where they're going, what the plan is, and make sure that you're taking care of your one of your largest financial assets and largest liabilities.
I agree with you. We, as a financial professional, we do this all the time because, you know what, when people move into retirement, you really want to understand where you're at, whether it be a mortgage, because I see some people, they say, hey, I've got $300,000 here, I want to pay it off before I retire. And I'm looking at them saying, okay, that's $300,000 that you're taking out of the ability to earn you an interest to something that's just going to grow in value, but you're not going to be able to spend. So it's going to reduce the ability for you to spend income.
Yeah.
And having a negative amortization mortgage or just allowing it to adjust will eat up a lot of their cash because the interest rate's going to rise because it's artificially suppressed. And you know what, they're going to be in a world of hurt. So I agree with you. You need to have that review each and every year. In fact, you know what, you should look at a mortgage as a debt asset like most institutions do. Because if you do, you'll realize, hey, it's time to refinance now when rates are lower and you can have the ability to lock them in.
Yeah, without a doubt. Or just plan for the future. Know when you need to take action. Because maybe, I mean, there are a lot of people that they're at 2.75% on an adjustable rate mortgage. It's very comfortable. But what's your comfort zone and risk for appetite, or appetite for risk, I should say. Because there is risk when something you know is going to adjust down the road.
And the reality is with those type of mortgages that you talked about, the negative amortization, the interest only that's going to recast, you know what, that could be the biggest risk they're actually taking on other than being in the stock market.
Yeah.
Because it could derail their retirement plan, it could derail the ability to live in their home the whole shot, so they need to have that checked out.
Yeah, we talk about it all the time, but it's proper planning. It's meeting with the right people, it's talking, it's looking over what you already have. And you have to look at your rental properties. I mean, don't just look at your primary mortgage, but if you have investment properties, if you have second homes, if you're looking to get into that marketplace, make sure you're setting those loans up for the long run. And you know, I like fixing in your long-term debt. You know exactly what you're going to pay.
Now, here's the question. With the recent changes in the Fed not raising interest rates, obviously the value of the dollar went down. What did that do for mortgage rates?
Well, we have to look at a couple of things right now. So fortunately, the first increase last year didn't do anything. If anything, mortgage rates went down. I mean, so it was great for mortgage rates. But what we do have to be careful of is looking at treasuries and looking at all the worldwide sort of money that's in treasuries. And China is also hurting a little bit, and they're raising capital. And they are pulling a lot of billions of dollars out of our treasury bonds right here in the United States. So if we don't have the money going into it, we could see mortgage rates, long-term mortgage rates go up just from that pressure alone. So it's something we have to be careful of.
So in other words, hey, if people say interest rates aren't going up, according to Janet Yellen, that might not be the big determiner here. So it's worldwide of what's going on.
And we live in this worldwide sort of financial, economic environment. Everybody's moving money around. Fortunately, the U.S. is still a very safe place to put money, mortgage-backed securities and treasuries. But when people start unwinding their positions, that puts pressure on, say, the 10-year, 30-year bond market. And there is a pretty direct correlation to long-term interest rates.
That's right. When interest rates go up, bond values go down. JJ, thanks for being with us today and educating our viewers. If you're looking to get some information or just do a mortgage checkup, you want to see the name and number on the screen, go to JJ's website, get some information, call him up, do that. If it's not JJ, go do it with your own. The last thing you want is your money falling through the cracks. Stick with us. We'll be back in just a moment.
Hi, my name is Steve, and this is my wife Amy. We just had our solar panels installed by Baker Electric. Living out here in the East County, the temperatures can be in the mid-70s to over 100.
We didn't know a lot about solar. Speaking with our solar consultant, he was there to answer any of our questions that we had. He was always there when we needed him.
I think the fact that Baker does go in-house with their employees, everyone is very professional and very polite, and they're on budget. We couldn't have gone with a better company.
Hello, welcome back. I'm Steve Sexton, your host. You know what? Here on the Silver Hair Tsunami, we want to educate, we want to empower. So in order to do that, when it comes to real estate transitions, we have a special event. You want to mark your calendars for May 12th, 5 o'clock at the Harbor Island Sheraton. Here's what's happening. You know what? We want to help people reduce the common anxieties and feel confident about their future when it comes to transitioning their real estate. In this day and age, when you start getting to 65, you have kids that might be living in the Midwest. You might want to sell your current property and buy one here in San Diego and one in the Midwest. You might look to downsize your residence due to health issues or move into a transitional living facility. Or you have rental properties and you're tired of them because you've been to Home Depot 1,310 times. And you're saying, hey, you know what? I want to do these things, but my problem is I bought the house for $100,000. It's worth $1 million. How do I deal with the taxes? How do I create income for the rest of my life and make sure I maintain that quality of life that I've always wanted in retirement? That's what this event is all about. It's on May 12th at 5 o'clock at the Harbor Island Sheraton. You're going to see that professionals give you advice on this transition. You'll have Alan Nevin, who you saw early in the show, talk about real estate here in San Diego, where to make money in real estate, and is it going up on an up or down? How does it work for you? You're going to have the top 1% of realtors. They're going to talk to you about how to prevent your money from falling through the cracks. You're going to learn the tax issues. How do I eliminate the taxes when I'm working through this transition? You're going to look at, hey, here's some options for creating income, because you need to create a sustainable income when you're in retirement so you can do all those wonderful things and impact the quality of your life. So again, join us. You're going to see the phone number on the screen, or you can go to the Silver Hair Tsunami website to RSVP now. For the first 100 that RSVP, Alan is going to be autographing and numbering his new book called The Great Divide. This is a book you want to get because it's going to talk about the next 25 years when it comes to economics here in the United States. Great for investors, great for people just to understand. So look forward to seeing you there. To get more information on the Silver Hair Tsunami event on May 12th, 5 p.m. at the Harbor Island Sheraton, go to the Silver Hair Tsunami website. We'll look forward to seeing you there. We'll be right back with you in just a moment. Hey, welcome back. You know what? I just want to tell you about this great show. We had Alan Nevin talk to us about real estate and economics here in San Diego as well as nationally. One of the big things he did say was he doesn't expect us to see a rate increase for quite some time. This is important to you because this is an opportunity to tackle that debt. It's about getting refinanced in a time where interest rates are going to be the lowest they're going to be probably for the rest of your life. And if you've got those high interest rate credit cards, this is the time to go find the ones that'll say, hey, you can pay 2% now and pay it off of a year. Focus on getting that debt taken care of, because that will make a difference in your life, because you want to be in a position where you earn an interest as opposed to paying an interest. So we want to thank Alan for that. On top of that, if you're looking to purchase real estate, hey, the market's going to keep going up. If you're renting, you know what's going to happen to you. It might be a wonderful time to look at buying. Next, we had Jonathan Jerotz. He talked about the biggest risk that he sees that people aren't focusing on when they have mortgages. That's the adjustable rate mortgages that could be recasting, the interest-only mortgages. Those are the things that could hurt you. So you do want to look at that. We at the Silver Hair Tsunami want to bring you information that will make a difference in your life. Most importantly, we want to help you make a prudent, informed decision that impacts the quality of your life. Now remember, to attend the Silver Hair Tsunami event, especially if you're looking at transitioning your real estate in the next 1 to 5 years, go to the Silver Hair Tsunami website. Again, that event is May 12th, 5 o'clock at the Harbor Island Sheraton. We'll see you there. We'll see you next week. Bye-bye.